Hi guys, and welcome back to my YouTube channel. Today I would like to make an overview of the financial market, starting from the simplest question that I can answer. That is, what is a stock? We'll see together what a stock is, who issues stock, how and why, and how these are priced. But first, thank you for stopping by. If you're new to the channel, here we talk about finance, fitness, minimalism, and things of that nature. So please smash the like and subscribe button, and let's get started. A quick disclaimer, I am not a financial advisor and this video does not contain investment suggestions. So, what is a stock? We can say that a stock, even called equity or share, is a security that represents ownership of a fraction of the issuing corporation. Starting from the first part, we can say that a stock is a security, so it's part of the realm of financial instruments, such as bonds, ETFs, and mutual funds that we'll explain in other videos, and represent a fraction of the ownership. Let's focus on this part. Stocks are nothing more than a title that gives to its holder the ownership of a fraction of a company. For this reason, the owner of the stocks is gonna gain some rights, but at the same time is gonna also face some risks. For example, owning a stock gives to its holder the right to be exposed to the results of the company that are periodically distributed as dividends, but also gives to the owner the right to vote internally during the shareholder meetings. That are meetings made by all the shareholders of the company to take decisions on important matters. The stock can appreciate or depreciate in value, and when the market is open, the holder can sell it for a profit or for a loss. Owning a stock means that in the worst case scenario, the price of the stock can go to zero. So this is the case of bankruptcy. But you cannot lose with stocks more than the money you invested. Owning a stock of Apple, for example, means that Tim Cook is working for you and you are paying his salary. Isn't that cool? But considering that there are outstanding more than 15.73 billions of shares of Apple, owning just one share will pretty much give you an infinitesimal part of the company. To be precise, it will mean owning something like 0.000000006% of the company. And considering that as per today, the total value of Apple is approximately 2.7 trillion, even owning 1 million of shares will not be significant. And that will already mean having a personal net worth that is above 150 million. I mean, it's not that I can buy shares and I can pretend to be higher than Apple. Can't I? Who can issue stocks, how and why? Stocks are usually issued by companies that need more funds to propel their growth. And these are usually corporations such as Tesla, Microsoft, Colgate or Coca-Cola. There are also smaller firms that are issuing stocks, but this is less frequent because the disadvantages of being a listed companies can outweigh the advantages, especially for small companies. When a company has its stock available for the first time on a market, we say that this company got listed on a market. To issue stocks for the first time and get listed, companies undergo a process that is called Initial Public Offering, or IPO. That is a process in which the current shareholders of the company offer part of their ownership to the stock market in exchange for money. The choice of getting listed is always a very determinant moment for a company, and it can pretty much make or break the career of the current CEO. The current shareholders decide to sell part of their ownership, to raise funds, to prepare their growth projects, or simply to exit from their initial investment. As they are selling part of their ownership compared to a bank loan, they will not have to pay back these funds. So let's make an example. Let's say that we have the Peanut Butter Corp. Yeah, I kinda like peanut butter a lot. I know. Peanut Butter Corp was created by the two brothers Alphonse and Edward. They get along very well. They founded the company 20 years ago and they put initially 10,000 euros per head. So a total initial capital of 20,000 euros. Initially, they both own 50% of the company for a total of 100%, and they take decisions together. 20 years later, they worked very well and they changed the world with their peanut butter. And now the company is worth 200 million. They both have a network of 100 million each, but they want to grow the company even more. So they decide to list the company to raise another 50 million euros and finance their expansion. The company goes for the IPO process and gets evaluated for 200 millions of euros and raises another 50 million euros on the market. Now this allows new investors to enter in the ownership of the company. With a base value of 200 million euros and cash for 50 million euros, the company is now worth 250 million euros. Alphonse and Edouard still own 100 million each of the company, so now they are shareholders at 40% each instead of 50% as it was initially. In this case, we say that they both got diluted because the initial percentage of their shareholding decreased from 50 to 40%, but the absolute value of their ownership is still 100 million each. They now have in the company another 50 million that they can use to support their growth. When a company goes for the IPO process, we say that the company went public. This is compared to a company that is not listed, that is called private. This definition comes from the fact that a listed company has obligation to issue periodically information on their financial statement and strategy. This is due to keep transparency toward investors, and this is instead an obligation that private companies do not have. For this reason, you can find a lot of information from investor relation pages from the listed companies, where they publish data every 3 or 6 months. How the price of the stock is determined? The initial price of a stock is determined in one of the latest phases of the IPO process, that is called book building. In this phase, we have that based on the valuation made by the advisor, that is usually an investment bank, and by the demand by the investors, we have the definition of a fork of prices, from which a final price will be taken. The event in which ownership gets transferred from the initial shareholders to the market is called the primary market. After that, every time the ownership gets transferred from one investor to another, we talk about secondary market. After the IPO, based on the buying and selling pressures, the price of the stock fluctuates over time. Moreover, in finance, there is the controversial efficient mark hypothesis, developed by Eugene Fama in 1965. This theory says that the price of a stock already discounts all the public available knowledge on the stock itself. Following this theory, the current prices of the stocks already englobe all the public available information and all the predicted events. In an efficient market, it will not be possible to make more money than market without using limited access information. Using limited access information to make trades is called insider trading. It is illegal. For this reason, the prices of stocks tend to be very volatile around the publication of new information, because previously private information become public all of a sudden. And investors can adjust their thesis by buying or selling stocks, moving the prices. About insider trading, let's make another example. Let's come back to Peanut Butter Corp. Let's say that Alphonse and Edouard, that are managing the company, are doing very well and that they are gonna make much more money compared to the expectation of the market. 1 week before issuing the new results, they buy a lot of stocks from other investors. And when the results get public, the whole world can see how well Peanut Butter Corp is doing, and a lot of new investors are gonna ask for the Peanut Butter Corp shares, increasing the share price. And now Alphonse and Edouard can sell their shares and fill their pockets. In this case, they used their limited access information, coming from the fact that they are managers of the company, to make a profit. And this is an insider trading event. So the prices of a stock are influenced on one end from the information available on the company itself, and on the other end from macroeconomical and geopolitical events such as interest rates or the war in Ukraine or the COVID-19 outbreak. So guys, I hope that this overview was clear. I'm open for any question you might have in the comment down below, and we'll have time to focus on all the details in other videos. So guys, thank you for watching, and if the video was helpful, please leave a like and subscribe, and go check my others videos here. Bye!